I've received a few emails and DMs from people asking for an example of a real estate syndication and how the process works. So in this video, I'm going to walk you through the entire syndication process from start to finish, including when to syndicate. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about our example of a real estate syndication. Before we get started, if you're looking for a video that explains a syndication structure, I'll put a link right up here to that video because this video is just talking about the process start to finish. So, first things first, let's talk about step number one. And the first thing we need for syndication is a deal. We need a piece of real estate to buy. And of course, this is a multifamily real estate channel. So the example we will use today is a 200 unit multifamily deal. Let's say it's $20 million and it's a value add and it needs another 5 mil of improvements. So that is the example we'll be running with. So the question is, when do we syndicate? Because we have a number of different options that we can use to acquire this property. If I have $5 million for the down payment and $5 million for the improvements, and I'm able to get financing for myself, I can just go out and buy this property on my own. I'm the sole owner. I can own it through an entity, which is most likely, or I can even buy it in my own name if I really want to. That is the most basic example we have. Or let's say I have a couple people who I know really well, and I say, hey, listen, we need $5 million total, then we need another $5 million to do all the improvements. We can split the $10 million 4 ways and we can all be owners and active participants. I can form a partnership with 3 other partners. Maybe 3 of them are bringing the capital, 1 of them is bringing the management experience, and everybody wants to be active in the investment. Nobody wants to be passive, everybody's active. And I'll put a link right up here to a video I did explaining about active investing in partnerships and passive investing through syndications, because there is a misconception that there is passive investing in a basic partnership, and that does not exist. So check out that video there. But let's say I don't have the capital, but I do have the real estate experience. So I've been involved in real estate for a long time. I know the market really well. I have the team built around me, but I just don't have the capital. Maybe I have a couple $100,000, maybe I have $300,000, but then I need the rest of the money. So a good chunk of that 10 million. I just don't have the resources myself, even though I'm fully capable and able to manage the property, get the deal under contract, all that sort of stuff. Well, this is where syndication comes into play, because syndication is built to raise large amounts of capital. So this is exactly the situation when or where you would syndicate the deal, because you would go out to passive investors who have the capital and they're looking to put that capital to work. They know that real estate is a great asset, especially multifamily. They're looking for the strong cash flow, the stability, the tax benefits. You would go out, acquire these investors, and these investors would then invest in your syndication. So if you're asking, when do I syndicate? Well, it's when you have the experience, the track record, the team, but you don't have the necessary capital and you want to bring in totally passive investors into the deal so they can earn a good return, get the tax benefits, benefit from the stability, the upside, the use of leverage. But you, on your own as a syndicator, you don't have the capital necessary to complete the deal. And step number 2 is due diligence. Due diligence is really a catch-all phrase, and it encompasses a wide range of things. You're checking the rent roll to make sure the rent that the seller is telling you is coming in is actually making its way to the bank account. You're making sure that the tenant that the seller says is in that unit is actually in that unit and paying what they say they are. You're doing inspections on the property, making sure the roof is in good condition. You're checking everything there is about the property. You're getting quotes for the work just to make sure your estimates are fitting what contractors are telling you. You are just making sure that everything about the property is how you think it is, how it was advertised to you, and if there are any issues, you can address it. Let's say the seller said the roof was 3 years old, but when you do your inspection, you find out the roof needs to be replaced. Well, this is something that comes up in due diligence, and you can address it. You can go back to the seller and say, Mr. or Mrs. Seller, you advertised, you told me that this roof was 3 years old. I made my offer based on that. And in actuality, the roof needs to be replaced. It is at the end of its life. What can we do about it? You're replacing the roof, or you're going to credit me on closing for the cost of a new roof, however which way you want to play it. So this is what due diligence is all about. Now, due diligence, even though I have it as step number 2, due diligence never stops. You are always doing due diligence throughout the entire process. You are always updating your numbers because you want to be as factual and accurate as possible. So let's say you find out a couple leases, they were $25 less a month than what was advertised, what was given to you. Well, you want to update your spreadsheets to reflect that because you want to have the best, the most accurate numbers going into your underwriting because garbage in, garbage out, you want to put in good, accurate numbers so you can give your investors a good, accurate idea of what the investment is going to entail. So you've got the deal under contract, you're doing your due diligence, checking up on the property. Now it's time to turn on the marketing machine. Now, every syndicator is different, but whenever a syndicator has a deal under contract or their negotiations are going really well, some people like to alert their database of investors and say, Mr. or Mrs. Investor, I have this deal we're looking at right now. If things go well, it's looking like it's going to be a great deal. Would you possibly be interested? And the answer is yes or no. Some syndicators will call a small group out of their database, key investors they have. Other people like to send it out to everybody and work with it on a first come, first served basis for investments. Everybody is different. So if you're looking, if you're talking with syndicators, if you're looking for information about syndicating, you want to ask the person you're speaking with how they work, what's their process, because everybody is different. The marketing machine starts up. So you're taking nice photos of the property, you're doing drone footage potentially, you're doing videos featuring the property management company, telling prospective investors what they like about the deal. As a syndicator, you're doing videos, most likely, webinars, Zoom calls, phone calls. You're getting the word out there to your database about the deal coming up. And so you're putting together marketing packages, usually a booklet. It's highlighting the key details of the investment. And it's really meant to spark interest from investors who may want to invest in the deal. The marketing machine is ramped up. You have interest now. People want to invest in the deal. And this is when we have your PPM or your OM, offering memorandum. Your private placement memorandum is the Bible of your investment. It has everything there is to know about your investment, and it's required by law because we are offering a security. So it's going to detail the structure of the investment, the structure of the syndication, who gets paid, when they get paid, what happens if X, Y, and Z happens. It's going to detail everything you need to know about that investment. So all the investors here in step 3 in the marketing phase who said, yes, I'm interested in investing in this deal. Well, in stage number 4, you're going to be sending the investors the PPM or the OM. And if you are an investor, you're going to receive from the syndicator that PPM. So that way you can have your lawyer review it if you choose to. Your accountant can review it. You want to make sure that you have the crystal clear idea of what the investment entails, what everybody's roles are, what's involved in that investment, and every question you have will be answered in that PPM. If you do have questions about what's involved in that PPM, you want to ask the syndicator and they'll be able to walk you through it. Somewhere along the line here, the syndicator is going to be setting up the entity that will acquire the piece of real estate. So let's say the building is called XYZ Apartments. Well, the entity might be called XYZ Property Incorporated. And that's going to be the entity that actually owns the piece of real estate, and then the syndication will be the types of shares sold in that entity. So that's going to be set up concurrently here because the syndicator will be getting ready that entity so it can be funded, which is step number 5, which is funding. In step number 4, The investors sign the PPM, or if you are an investor, you sign the PPM, you are committing to purchase X number of shares as a limited partner, as a passive investor in that entity, and receive all the benefits that entails. Step number 5, you are wiring the money into the bank account for that entity. Closing can't happen without the money. So this step is really important. As an investor, you're going to wire your investment into the bank account, and that's going to happen before closing because the entity setup that's going to acquire the piece of real estate needs those funds to actually close on the property. So let's say we're closing on December 1st. You're going to be wiring money into that account a couple weeks up before closing. Every syndicator is a little bit different, but there will be a hard funding, a date when the deal must be funded. Then step number 6, you have closing. The deal closes, like I alluded to, all the money's in the bank account. Everybody's ready to rock and roll. The management company is ready to take over the property and put into place the business plan. Closing happens, it's a day for celebration, but then it's time to roll up your sleeves because as a syndicator, as the people managing the deal, that's when the real work begins. That's when you're putting into place the business plan, whether it's doing renovations, optimizing expenses, operations, putting in new management team most likely, changing up the advertising, rebranding the property, you name it. A value add plan has many different moving parts, and I'll put a link right up here to a video I did all about the value add process when it comes to multifamily real estate. But syndication doesn't end there. Closing day, like I said, is just the start of the process, and there's things that have to happen throughout the whole period, because in most syndications, you are involved in that investment as a limited partner, as a passive investor. The whole period can be 5 to 7 years. Sometimes it's 3 years, 4 years. There's even syndications that go up to 10 years. It all depends on the specific deal and what that property needs. So it's not just closing day and you set it and forget it. As an investor, you will be receiving your distributions. Sometimes distributions get sent out quarterly. Other people like sending them out monthly. It's up to the syndicator, so that's one question to ask. If you are considering investing with somebody, do you send out distributions on a quarterly basis? Do you send them out on a monthly basis? These are good things to ask and good things to know. As the syndicator, you're working hard with the management team, the property manager, to put that business plan into place. So if the rents are below market value, you're putting into place your increases to bring that up to market. You're renovating units if they need renovations. You're changing the branding, changing the advertising. If you're looking to change over the tenant profile, you're finding which tenants that you're going to have move on, so you can bring in different tenants that fit the community you are trying to build, all with the goal of improving the property's value, because this is how the investors earn their return. You're increasing the cash flow so their distributions go up, and then you're increasing the NOI of the property, which will in turn increase the value of the property, and then that means a higher sale price. And that leaves me to number 7, which is the sale of the property. Now, sometimes, depending on the deal, you may have a refinance at some point. So if the property has been improved so much to a level where you can refinance, put extra debt on the property, but then return some money to the investors as a passive investor, you're going to get a chunk back of your initial investment. And since that money is returned, that's going to increase your returns on the deal because you have been returned some of your initial capital. That may or may not happen in the deal, so I didn't set it in stone. But at some point, it becomes time to divest of the property, to sell the property, because we look at return on investment and return on equity. And with the value add play, when you're adding lots of value into the property, there comes a point in time when you have so much equity locked up in the property, and we only have so long for those tax credits, it makes sense to sell, so then we can move into another syndication and start the process all over again. So the sale happens. And the same process happens for the new buyer. The new buyer will get the deal under contract, they'll do their due diligence, and then they'll go through this entire process with their own investors. What happens with the passive investors and the general partners in the syndication that's selling on closing day? Obviously, that entity is dissolved. All the money is paid out to the investors, and that's when, as a passive investor, you get your biggest check. One thing I like to say is the cash flow during the hold period, so let's say you're holding the deal for 5 years, Cash flow is like breadcrumbs. It's like, who was that? Hansel and Gretel, I think, in the woods. The breadcrumbs along the way, and then at the end, you get your big chunk of money right here from the sale. Because in the value add play, in a value add investment, you're building up, you're pumping up the property full of value, increasing the NOI, and that's when you're going to get your big check. So that is the syndication process. The board got a little bit messy, but that is the process from start to finish, and we even touched on when to syndicate. And like I said, syndication is an excellent way to raise large amounts of capital from passive investors. Syndication is built for that very purpose. So we've got the deal, then we do due diligence, then we start marketing the property, then we send out the PPM, the OM, we fund the deal, we close it, we manage the deal, implement our business plan, and then eventually we sell, and then the process starts all over again for the new buyer. So if you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you'd like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.